what I was hoping to do today is basically talk about anchoring and explain what anchoring is. It's one of the more common behavioral biases, and I wrote an article on my column on StockCharts.com called The Mindful Investor. I wrote an article there yesterday talking about anchoring, and what I thought I would do today is just dig into a little more detail and unpack what anchoring is, why we're hardwired to make decisions based on mental anchors, and then talk about some of the ways that I've found over my career to minimize the impact of those anchors on your decisions. But first, there's a poll that we have going on for this segment, and it relates to the broad market. Tom and Aaron and I were talking before the show about what we would want to ask all the viewers, and I was most interested selfishly in sort of where people were at. We've had an undeniable bear market in the fall of last year, and all of a sudden has reversed so quickly in such a dramatic fashion, and all of a sudden charts have gone from looking incredibly negative to incredibly positive so quickly. And so I'm very curious as to where people are at. So, at this point, I think with a pattern of higher highs, higher lows, with all the charts that Tom was showing you earlier, it's hard to say that we're anything but, in an uptrend in the short term with this pattern of higher highs and higher lows. Over the longer term, I think there's potentially some argument, but there's no denying the last, 2-3 weeks have been fairly positive. So the question to all of you is, at what point, what would you need to see to turn negative or to turn bearish on the short-term market environment? What would make you start to question a bullish thesis here? And we gave you 5 choices. The first one is to fail at the 50-day moving average. And this is just a daily chart of the S&P 500. This is the daily chart that I've had up for a while. And again, the pink lines are sort of my own drawings, but we also have the 50 and 200-day moving averages and then RSI below here. So, at this point, we've rallied up right up to the 50-day. So option one, first choice would be we fail at the 50-day. We're unable to eclipse it, much like we did here at the end of November, which resulted in a new move down. Would that convince you that the market's turning lower? Second would be a trend line break, which I've drawn a trend line using the December low that connects to the January low, that connects to the low we've had in the last couple of days, and we've remained above this sort of general trend line. Would a break below that trend line convince you that the uptrend is over? And also, if you're familiar with Arthur Hill's work, which he does a fantastic job writing on StockCharts.com, he talked about this bearish wedge pattern where you have higher highs and higher lows, but in a converging pattern where they're sort of coming together. So if you draw a line up here, you can sort of see this wedge. If we break down there, that would violate the trend line and give a negative pattern. So option two, that would make you be negative. The third option would be a violation of the most recent swing low, right? So if you see this as a pattern of higher highs and higher lows, we start to break below some of these swing lows. We go to a new low on the daily chart. Would that convince you? Fourth option would be defensive rotation. So we've had this situation where, of offense to defense. This is the relative rotation graph that I'm sure many of you are familiar with. These are many of the defensive sectors: utilities, staples, healthcare, real estate. Here's our traditional offense: consumer discretionary, industrials, technology. Do we see enough of a rotation where the offensive sectors really start to appreciate and the defensive sectors continue lower? Is there something with the sector rotation that we convince you that we're now turning lower? And then option 5 is something I've not mentioned so far in the other camp. So I'd appreciate, while I sort of talk through anchoring, take a few moments and think through this chart of the S&P or whatever daily chart you have in mind. Think of those 5 choices and let us know where, at what point you would start to turn more negative on the market. And then at the end of my segment, we'll revisit that poll and see where we netted out. And then at that point, I will, not that I'll give the right answer, but I'll certainly give my take on how I would answer that question and why. So anchoring, I'm sure many of you are familiar with it. And if you're not familiar with what anchoring is, you will by the time we're done, because it's something that affects your decisions that you make day to day, and not just about your investment decisions, but about any decisions. When you go to buy some milk or refuel your car, or get in a relationship with another person, anchoring, part of that mental anchoring affects your decisions. And what anchoring is basically locking into a specific reference point that then affects your subsequent decisions. So there is something in your head, some experience, some item, some point of view that you anchor to, and then your subsequent decisions are related back to that initial anchor. Now, one of the examples that I'll share on anchoring is I used to teach technical analysis at the university level at Brandeis University on the west side of Boston. And I taught master's students, so it was MBAs and MSF students and masters in economics, and interesting group. And at the beginning of every semester, I would start to ask them about where they saw the market going through the course of the semester, and that would give us sort of a a frequent discussion point at the beginning of every class during the course. Now, the one time I did it, what I actually did was I broke the class into two groups, and for the first group, I said, okay, where do you think the S&P will be at the end of before our last class, and would just let them answer it, and I would gather all those responses. To the other group of students, I actually used an anchor. So what I did was I said, tell me where you think the S&P is going to be at the end of the semester. And I've surveyed earlier students, and their average response is around 2,100 or whatever level I threw out at the time. So the moment I did that, what happened was I anchored that second group of students to that price level, 2,100. And as a result, if they were going to say something really low, like 1,500, they would probably bump their response up a little bit because it was way too far from the anchor. It seemed way too out of normal. Same thing on the other side. If someone was super optimistic and was going to say S&P 3,000, the fact that I'd anchored them down, they go, okay, maybe I say more 2,700 or something. So the anchor that I gave them by priming them with that first number, I was able to affect how they said. And as a group, the second group came out a little lower because they were anchored to a lower starting point. So that is a simple example of what anchoring is. Now, how is that actually reflected in our investment decisions? Well, this is a chart of Home Depot, just a daily chart looking at the last year. And again, not making any recommendation of what I'm seeing right now, but let's pretend, for example, that you bought Home Depot around 172, which is right about in the middle of this big open candle here at the beginning of January. Let's say you bought it right in the middle of that day. And so that price level of 172 is your buy point. What's happened when you have a buy point, and buy points, the entry points to a trade are one of the more common anchors that you will face, because what you've now done is you've mentally anchored to that price level. As long as Home Depot remains above 172, you have a certain feeling. But the moment it breaks below 172 and you're now at a loss, you start to have an emotional reaction. Even if you don't want to, you react to the fact that you're now in a losing position. You start to think about when you might want to reevaluate it. The reality is, even though that entry point of 172 has meaning to you because it's where you enter your position, the market as a whole could not care less about the fact that 172 means something to you, right? To the market as a whole, it means very little because it was just in the middle as one data point among millions of data points looking over this time period. So by anchoring to that point, all of a sudden you start making subsequent decisions related to that initial point. And at times you will make the wrong decision based on, what should be a pure look at the evidence. The trend is doing a certain thing. There's a breakout, there's a breakdown, there's a violation of a certain level. But by anchoring to that point, you're making an emotional decision based on your trade in your position, as opposed to just looking at the evidence and making a clean decision. Now, why would we anchor? Like, why does it even make sense that we would do that? It's clearly something we're hardwired into our brain. And I will tell you, I mentioned earlier, like if you're buying milk, right? So if you see that milk is trading for, $1.50 a gallon or some random number, right? The fact that you've bought milk before and you have a sense of what milk usually costs, you're able to make a judgment call as to whether milk is rich or cheap, right? Can I buy it for cheaper than I normally would, or is it really expensive? And by anchoring to that sort of average or to where you've bought milk before, it allows you to make a better decision about it. And not just with buying decisions, but with anything, that those anchors in some ways can actually be a good thing, because it allows you to make a value decision, make a judgment call, evaluation based on prior evidence. But why do we actually do that? So what I've read and what I've learned is that anchoring is a hardwired thing which allows us to make sense of a very chaotic world, right? If we weren't able to anchor on some value, the numbers of people and experiences and their faces and what they're doing and all of the stuff happening around you, you are one piece of a huge, operation in your city, in your country, in your world. And if we didn't have some sort of mental anchors to make sense of that, it would be incredibly overwhelming. I think we wouldn't be able to make any decisions at all. So we do it as a way to make sense of what's happening around us. We do it to have some frame of reference, that we're not just making a random decision based on random data. We're able to compare data back to a starting point that has meaning to us. So in general, is being aware of your buy point a good thing? I would argue yes. Does it help you to make better decisions? Well, I would say this, right? So if I asked all of you how many stars there are in the universe, right? You probably have absolutely no idea unless you're an astronomer, which I'd assume most of you are not. So if I said how many stars in the universe, we would get some completely random numbers. And I asked my 11-year-old daughter how many stars she thought there were in the universe. And I think she said 100,000, which good guess, Zoe, but that's not true. So what if I anchored you to a starting point and I said, how many stars are there in our entire universe? But in our galaxy, which is just our little piece of the universe, there's about 100 billion stars. So it's got to be way more than that because there are millions and millions of galaxies. All of a sudden, I've anchored you to a number that makes a lot more sense and would allow you to make a much more informed call. So my point being, anchoring is where you are primed with some starting point. Anchors, in general, prevent you from making good decisions with your investments, which we'll get to, because what happens is you don't want to be anchoring to a point that's not meaningful. There are times when it can be helpful, and I would say from a money management standpoint, anchoring to a point, especially where you feel like you need to make a change in positioning, can be very good. But in general, we're going to talk about how to minimize anchors. So let's talk about this chart of Home Depot, and we'll talk about a couple different things. There's 3 ways that we can, in my opinion, that I've learned that you can minimize the impact of anchoring. The first one is and in general, what we want to do is disorient ourselves and focus on the evidence. So number one, we want to disorient ourselves. We want to unplug from the anchor. We want to forget that on this chart of Home Depot, that 172 is meaningful to us. We just want to look at the chart and look at the evidence itself. And by focusing on the evidence, then we're able to analyze the trends, analyze the price movements, analyze the supporting evidence of oscillators, relative performance, whatever else. But we're doing it from a clean slate. We are starting fresh. And then we can compare our analysis back to our positioning, back to our, use our money management skills to combine our analysis back to our positioning and where we want to go. So 3 things that I can suggest that will allow you to minimize the impact of anchoring. The number one, and it's so simple, and I can't show you because I'm literally holding my hand over my screen. The first step is to cover up the ticker. And this seems juvenile and not a very technically oriented one, which is totally fair, but it'll work. So what happens is up here in the upper left corner, I can see that this stock is Home Depot. So when I'm looking at the chart, I want to look at the price. I want to look at the trends. I want to look at the price patterns. I want to look at Dow theory. I want to look at oscillators. But I don't want to make a judgment based on the fact that this stock is Home Depot. Because the moment I think of this not as a price series, but as a chart of Home Depot, I am now anchoring to some prior experience I've had with Home Depot. I will remember the time that I bought Home Depot and it rallied and made me a ton of money when it was my best performer. I may remember a time when I was on the wrong side of it. For example, if you owned it, in late September, right before it fell off a cliff and you held on too long, those experiences are now going to anchor, and you will anchor to them, and it will affect your ability to make a good decision now on Home Depot. What you want to do is start from scratch and say, right now, if I had new money, would I buy a Home Depot today? And if the answer is yes, then you want to compare it to how you're positioned and see, are you reflecting that in your positioning? So literally what I would do is cover up the tickers. And the great thing about stock charts, it's right here in the upper left corner. You cover it with your hand and you can easily go through it. I've also copy and pasted things in documents and put, covered up the tickers with some object or something, which is totally fine. But as a quick thing, just cover up the ticker and just do the analysis. Forget what the company is, forget what sector it is, and just look at the chart itself. Now, in general, I would say with each of these 3 tricks I'm going to tell you, over time, what I found working with technical analysts for my career is the best technical analysts, the seasoned pros who have been doing this and have a really good process, they don't need to cover up the tickers anymore because they're able to look at the chart and not be influenced or biased by some anchors or minimally so. But as you're getting started, as you're getting comfortable with going through charts like this, covering up the tickers is a great way to just forget about what the stock is and just look at the chart itself and focus on the price movements. So the first trick, just cover the tickers or forget what the ticker is. The second trick is to invert the chart. Okay, so we're going to switch gears to Apple, which I'm sure many of you know. So this is a chart of Apple looking at the last 1 year. So this is a trick that I've learned using StockCharts.com for a while. Many of you, or some of you may not know, if you add a minus sign in front of any ticker, it'll quickly invert the chart. Super simple way to just shake it up a little bit. As I mentioned, disorient yourself, start from a clean slate. So now forget what this stock is, Forget that it's Apple, forget what it's doing, and just look at the prices itself. What do you see with this price? Well, again, I'm just going to do a quick, simple Dow theory analysis. Do we see higher highs and higher lows? Absolutely. We see a clear pattern of higher highs. We see a clear pattern of higher lows. I don't see a violation of support yet. It's actually holding up on support around this level here. So overall, would I rather own the stock or not own the stock? Again, based purely on that simplistic analysis, I would think this is a good long idea with a pattern of higher highs and higher lows, and it's pulled back to a potentially good buying point. Now we compare that back to what this actually is. All right, this is an inverted chart of Apple. So what I basically said is if this is a great long idea, then this should probably not be a long idea if I look at the regular chart of Apple, right? If the inverted chart looks so good, by definition, the regular chart looks kind of bad because it's a pattern of lower lows and lower highs, and we're right at resistance and we haven't broken it yet. So, and again, this is not designed to be an Apple call, but more designed to illustrate the point, which is just by inverting the chart, you will start to see things that you wouldn't see otherwise. But, you know, if you remember, those of you that in kindergarten or preschool or something like that, one of the things I remember doing is tracing a picture of an elephant, but they turned the picture of the elephant over. And so you're just tracing lines. You're no longer tracing an elephant, you were tracing lines. And when you trace the picture of the elephant right side up, you actually did worse because you saw it was an elephant. You're trying to draw the trunk just right and everything and the legs and all of that. But when they inverted the picture and you're just tracing lines, everyone's picture looked way better because all of a sudden you're just drawing lines on a page. You weren't worried about the fact that it was an elephant. You disoriented yourself from the visual image and focused just on the lines that you were drawing. And that's what we're doing here. We're inverting the chart. We're disconnecting from the fact that this is a company that we know with products that we may use and a stock that we're familiar with, and we're just looking at the prices and the trends. Then from there, again, I would always go back and then think about the fundamental stories of Apple and the product line and the projections and all of that. But just for the pure chart read, you can disconnect from some anchors just by inverting the chart and starting from scratch. The third thing that I would suggest is to remove the price. So what we do here, I actually have a chart style that I've created, and then I'll explain to you what I did to create it. Whoops, I actually didn't do it here. Hold on. So we will take this down, and here we go. So this is now a chart, and I've eliminated the price. I am looking at two moving averages. I'm looking at RSI, and I'm looking at the relative performance. So forgetting about the chart, forgetting about the stock, forgetting about the noise, let's just look at the trend. Well, the 200-day moving average has been sloping higher for much of the last year, much less 12 months. But starting in December, it started to slope downward. So I can assume, based on the fact that that moving average has transitioned from bullish to a bearish phase, that this stock is now in a downtrend of some sort after being in a long-term uptrend. This is the 50-day moving average. The fact that it rallied up, I can assume that this stock had a really good movement through the end of the summer, beginning of the fall, but then turned down very quickly. And now I would assume it's at the lower point because the 50-day is below the 200-day and they're both sloping downward. So overall, this is stock that's been in an uptrend, but it now has come down a little bit. The RSI tells me that the stock has probably bottomed out recently and has rallied just a little bit off the lows by the fact that it's oversold. I had this higher low and now it's broken to new highs. But overall, the stock is still not in a good relative position because it's been underperforming pretty consistently for the last 6 weeks, right? So all of that analysis I did without looking at the price itself. I just looked at the moving averages. So I just looked more at the long-term trend. And then I looked at some of the supporting evidence, what I would call the confirmation, using things like RSI, the relative performance, and so forth. By eliminating the price, all you're doing is eliminating the noise. You still understand what the trend has been, but you're not starting to get biased by some of those short-term movements. Now, would I ever suggest that you buy or sell a stock without looking at the price? Absolutely not. This is not the answer to the question. This is the beginning of an exploration of a stock and a trend, right? So you start with this sort of thing just so you're not too biased by the price movements, because the more you look at charts, the more you will recognize the chart of Apple the moment it comes up because you've seen it a lot. You just want to look at the trend and answer it like you would a checklist before you start an airplane. Here's what the moving averages are telling me. Here's what RSI is telling me. Here's what the relative performance is telling me. At the end, what is the mosaic overall? What is my overall picture on the stock? And then you add the price back in, and then you start to make some assumptions on it. So this last one may be less familiar with you for some of you. So I'll show you, a friend of mine showed me how to do this earlier, and I think it's fantastic. So there are two things you would want to do. The first is there's this, you want to make it less opaque. You want to make it basically transparent. So on average, this setting is at 1, and you want to take it down to 0, which basically means make it, eliminate it. I'm no longer going to see the level. And then there's also these y-axis labels, which I would take off, because all that does is when you have the y-axis label, it's going to start anchoring you to some price level that you see on there, and it's going to tell you where the price is, and you don't want any of that. So if you deselect that, change the setting down to 0, it will remove the price. And so I've created a template that just eliminates those quickly in case I would want to do it. Now I can add the price back in, and now all of the analysis I do on the individual price bars, on the candles, on the short-term candle patterns, on the gaps, all those tactical things that are really helpful, I'm now doing it within the framework of a trend and a framework of, not being biased by some of the price movements I may have been familiar with or anchored to before. So the 3 ways we can minimize anchoring: number 1, cover up the tickers; number 2, invert the chart by adding the little minus sign before any ticker; and the third thing is just remove the price altogether. Take the price out by making it less opaque, like you have the setting here, and just look at the trends. And again, these are just some of the indicators that I use. This is a great opportunity to add a couple more indicators on there and just look at the overall picture. Look at each piece of evidence and figure out what you're seeing. So as a closing thought on anchoring, I would remind you that anchoring is not always a bad thing. And I've actually had, I will tell you, nobody's perfect. I've had plenty of arguments with other behavioral finance aficionados, some of my peers around the industry and in academia, about anchoring and whether or not it can be a good thing. I tend to think it can, because I would say when you anchor to something and it allows you to make a better decision, make a decision that will be a good value decision, for example, I think it can be helpful. The problem is a lot of times we do, undisciplined anchoring. We anchor to something we don't realize it's happening, and as a result, it affects our ability to analyze the evidence from a pure standpoint. So, where is it a good thing from a technical perspective? I think, being familiar with your buy points and at what level you would reconsider your positioning, I think can be a really important anchor to be familiar with. So again, I am not long Apple or recommending it, but let's just say, for example, that I bought Apple right here when we pulled back to 150, and now I'm in the short term happy with that movement, for example. One of the things I would remind all of you, and Tom and Aaron are doing a great job of showing some of these things. I've always said to treat your charts like a workbook. Don't treat it like a painting. So you don't want your charts to be some pristine thing that you never touch, that you're hanging up on the wall, and there it is, this beautiful, clean view. I would treat your charts like a workbook. This is a way to capture what you're thinking and what you're seeing, and at what price levels you think you want to revisit something. That's really, really important. So at this point, I've drawn a line at the point where I bought this stock theoretically. So I'm always now looking at where this price is relative to my buy points, and I might want to put a comment in here so I can remind myself, bought X at something, and just so I remember what I was thinking at a certain day, I might want to put the date in there as well. And then you can save these charts in a chart list. So I have a chart list called brokerage. I have a chart list called long ideas and any other things. And when I actually put a position on, I put notations on, I save the charts, and I put them in there as a way to remember levels that are really meaningful to me. And then as the price goes on, as the future goes on, you can see how the price moves relative to those important levels that are of interest to you. So my final thought to you on anchoring is treat your charts like a workbook. Don't treat them like a painting. So at this point, if it's okay, that's my presentation on anchoring. I would love to revisit and see the results of the poll and talk about where everyone thought that we're headed, and of course answer any questions that might have come through the chat room.
Yeah. Go ahead.
Go ahead, Aaron.
I did get one from the chat room I just noticed. The person is wondering whether this works for day trading or momentum trading, and like any stocks and an ETF. I mean, that's, I guess, what the question was.
Yeah, good point. So the answer is it pretty much works for everything. We make these decisions using anchors for pretty much everything. And so it's anything from a technical perspective, anything with price allows you to do some of these techniques, to be honest with you. And so a lot of times what I would suggest is use ETFs, because you can find an ETF that tracks pretty much anything, a sector, an industry group, a commodity, a currency, the dollar, interest rates. And by doing those things, inverting it, flipping it over, covering the ticker, all it does is it just removes what it is and just focus on the trend. So it could work for anything. In terms of timeframes, I say it's all, your charts always want to reflect your investment horizon, right? So I tend to be thinking out on average, I'm looking, 3, 6, 12 months down the road when I'm looking at charts, which means I'm looking at a lot of weekly charts, 5-year timeframes to start with, because that's the amount of time I would want to start with to project out that further. But if you're looking at the next couple days, I would say you want to be looking at a shorter term chart, like a 6-month daily chart, and applying these techniques we've talked about, but just looking at the swings on the shorter term time frame. Same thing with intraday data, all of that. It all comes back to whatever's a meaningful time frame for you.
Hey, Dave, it was a revelation while you were going through this whole thing. I realized now that if I went back and I put a minus sign before all the stocks that I traded in the fourth quarter, I had a much better return.
Yeah, that's never a good feeling when you invert all your holdings and you get really excited. So that's a good lesson, Tom. That's
yeah,
true.
Some of the stocks I thought really look good, they do, but just inverted.
And it's funny that the tricks that I talk about, it's such a simple thing, but a lot of the bias, a lot of the challenges we face is just visually we'll be primed for something. So another common thing I've always said is never confuse the bottom of the page with support. So just because the price has gone down to the bottom of your chart doesn't mean it can't go a lot lower. And look at charts like Crocs or GE or any of those stocks that have gone down in a meaningful way, and you'll see what that means. So by inverting it, you just disorient yourself that okay, now it's at the high point. Okay, what does that mean? And yeah, but yes, if you get that sort of ecstatic feeling inverting your charts, you want to revisit your positioning, Tom, for sure.
All right, now I do have a question on anchoring though, because when I look at the results to the poll, I'm wondering if I'm somewhat anchored because I believe that in the short term the market needs to roll over. And I do look at certain levels. I mean, I've been talking on Market Watchers Live now, probably for the last few weeks about 2581. That was a key support level on the way down. And
Sure.
now it's, the market's reversed and it's gone back up. And we see the S&P now a little bit above that 2581 level. And I do find myself continually thinking that, hey, maybe if we get back down below that 2581 level, we're going to see those sellers start to kick back in. So I guess a couple of questions. Number one is this anchoring isn't necessarily just about individual stocks, but it could be your view of the overall market, number one. And then number two, when you're buying or selling stocks, or let's say you're looking to enter stocks and you really don't want to get attached to a particular price, for you personally, if you're going to look to buy stocks, do you start with a scan of some sort with maybe a trend, maybe a short-term moving average crossing a longer-term moving average? Or how do you go about buying stocks if you're just simply trying to get past certain price points?
Great. Two really, really good questions, Tom. So in answer to your second question about how you scanning or how you try to disconnect from prices, I would say that it's really, especially nowadays with decimalization and stocks trading at sub-decimals and the volatility that we're having, it's very difficult to focus on a specific price level and expect it to be a hard ceiling or a hard floor. So I have found, and now if this was 1992 and stocks are trading in 8ths or 16ths, then you actually could expect that a stock hits a certain level and reverses because there's limited points it can be, but that's kind of behind us. So I tend to screen less on individual price levels and focus more on meaningful signals that would inform me as to a change in price. So things like moving averages, MACD is a common screening tool I'll use, or PPO, something that's just, something that's been in one phase and now it's turning. Now the price levels and all of that will be reflected in the chart, but it's easier to screen on a larger universe by using something like some trend-oriented technique. The other thing I would say is when you're looking at individual stocks, I've always found that instead of thinking of a specific price level and, consistently checking the chart for a certain level, all of a sudden, the more you look for that price level keeps getting banged into your head over and over. And all of a sudden it means more than it should. So I would always set a price alert and then forget it. And then it'll tell you when you need to start worrying about it. You don't have to think about the price level anymore. So those are two things I would say in terms of scanning and on individual names. On your first question, I would say, you bring up a really good point, which is, does anchoring affect your, overall market decision, right? Or are you anchored to a certain idea and then that affects your decision. So I would say that what you described to me sounds less like anchoring and sounds more like confirmation bias, which brings up the really meaningful point that any of these behavioral biases that we talk about, they don't happen in a vacuum. And you are affected by a lot of different things that you read and that you see and that you hear, and just your own mental programming that affects your decision. So, confirmation bias is when you mentally think, I'm bearish, and then all the charts you look at, you're just looking for evidence to support that bearish claim. And if you see something that's bullish, you kind of push that to the side mentally because you just want to validate your own opinion. In general, we tend to use these together. So you're anchored to you're trying to confirm some preconceived market opinion. You're bearish, so you're looking for bearish evidence. But then you also anchored to some price level that all of a sudden affects your something that triggers that level. You're like, okay, great. Now that's a piece of evidence. So it absolutely is related, and I would say definitely affects what you're going to see with the broad market. And of course, even though that is how we're wired, you want to do that as little as possible. You want to focus just on the evidence. And so I have always coached people just getting started, make a list, handwritten list. Here's what I'm seeing from all these different points, these different data points, and then look at it all together and evaluate where you want to be.
Okay, fair enough. I know looking at the poll here, I could probably answer, and maybe everyone out there thinking the same thing, I probably could answer a couple of these. So I kind of looked at it as to which one would be more meaningful to me. And I know for me, I went with the break of the trend line, support, and the wedge.
Yes. It's interesting. I'm actually surprised how much everyone's grouped onto the failure at the 50-day. If you think about each of these things, the failure at the 50-day is one of the more leading indicators, right? That would sort of be the beginning of the move, whereas a break to a new low or the break of the trend line would be more of a confirmational move. That's something that would happen after we sell off a little bit further. So it's interesting that what that tells me, and I am totally on board, the fact that we've rallied so quickly, the V bottom out of the lows, and now, I mean, you showed some of the banks actually rallying after they've been so bad for so long. Boy, it feels like this has been so quick, and some stocks are becoming overbought in the short term, which, you're just looking, it's going to take one bad day to all of a sudden make it look a lot less attractive than it has. So I'm not surprised people are saying that. It tells me that, we're all sort of waiting for some signal that tells us that this uptrend is not just going to go straight up to S&P 3000, which I certainly don't think is going to happen. All else being equal, Tom, I'm sort of in your camp. I would look at a break of the trend line as being really key. And depending on how you drove that trend line out of the lows, we either just broke below it or have just retested it. And until we get a confirmation below there, by definition, the trend is up. So the way I'm seeing it is, as long as we stay above that trend line of the lows, the trend is positive, especially the short-term trend. But long-term, overall, I think with the negative breadth that we have seen from a longer-term basis, the rotation to defensive sectors that would take a lot to kind of reverse, I feel like there's still more backing and filling we would need to see from a longer-term perspective before I could get really bullish in the long term. But great, thanks everyone for answering that. It's really interesting.
Yeah, I know looking at the market, I think most technicians, we're not used to seeing too many V bottoms, especially when the market sold off on such heavy volume at the end of the year, which normally, by the way, December is a very bullish historical month, and December was just horrible. And now we've got this huge move to the upside. So is there a point, or is there something that you're looking for that would suggest to you that we're not going to go back down and retest those lows? Because I think most technicians would expect at least a retest of what we saw in December. But as it keeps going higher, I'm sure everybody thinks this way. When do you say, you know what, maybe we're not going to go back down there? Is there something that you're looking at there?
It's a really good question. So in my opinion, I think getting to the defensive sector leadership you talked about, I think that if you see a rotation away from defensive sectors, a rotation more to offense, which would be driven, what appears to be, driven by things like, Amazon and Netflix, which, charts that had looked really bad not too long ago, a couple weeks later, all of a sudden are breaking out of these congestion patterns. So, leadership from some of the traditional leadership spaces, financials recovering. I mean, if that is a trend that continues, it would be really hard to stay, to expect a lot of downside if you really see meaningful movements. From a broad market perspective, it's all about, in my opinion, at some point we correct, right? We have to. We're not just going to go straight up. At some point we correct, and where that correction goes to, I think will be the most important thing. So if we start to hold previous support levels, right? More recently on the S&P, that that would tell me another higher low here. And especially on the weekly chart, if you'd see a higher low, which we haven't really seen yet, that would, for me, tell me to be, to be less negative and maybe expect at the very least more of a sideways kind of choppy market. And then broadly speaking, right, 2,700 is the midpoint of that symmetrical triangle from the first half of 2018. If we get meaningfully above 2,700, and this is, more of a trend following take, if we break above 2,800, which is the ultimate sort of line in the sand, then I don't see how you could be negative. You have to be, pretty bulled up at that point, in my opinion.
Okay, fair enough. Well, I certainly appreciate you coming on here. It's always great to hear from you, and I think it gives everybody a little different perspective on how maybe to take a look at these charts and to try and get away from some of these biases and anchoring and so forth that I think everybody's guilty of.
Absolutely. Yeah, appreciate it. Always a pleasure to join you guys. Thanks, Tom and Aaron.
Yeah.
Appreciate you coming by, and we'll definitely have you back. Also, I want to just let everybody know that Dave does write a blog at StockCharts. It's called The Mindful Investor, so you can go in and check that out at any point. But always a pleasure having Dave on with us.
Hi, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. Today's instructional video is going to tell you all about scooters, the StockCharts technical rank. Here are the topics and the timeline for today. First, we'll show you that this is based on John Murphy's methodology. Then we'll go over the indicators and the weightings. We'll look at some chart examples of a weak versus a strong scooter. We'll look at how scooters are ranked and grouped, and then we'll show you how you can work with scooter tables. John Murphy's methodology. The StockCharts technical rank is based on a numerical score that is derived from 6 indicators with different weightings. The methodology for these rankings comes from the wisdom of John Murphy, and John Murphy is, of course, the author of many books on technical analysis. John is also a key contributor to the commentary here at StockCharts.com, and you can read his post every week here. Indicators and weightings. If you want to see some written documentation on scooters, the methodology and the indicators, you can find a very detailed article in our chart school. So you can see the link for the chart school up at the top. If you click on that link, you will be taken to the main page for the chart school. And I'm going to go to the indicators and overlays section, and that has all of the indicators that we have available on Sharp Charts. And near the bottom, you will see the StockCharts technical rank. And if you click on that link, you will get a detailed article on how the StockCharts technical rank works. So if you want to know about the calculation and the indicators used, you just scroll down this article, and there you can see a table with the indicators and their weightings. We have 2 long-term indicators, the percentage above below the 200-day EMA and the 125-day rate of change. Those each count for 30%. Then we have the medium-term indicators, the percentage above below the 50-day EMA and the 20-day rate of change, and both of those account for 15% each. And you can see we have the short-term indicators, the 3-day slope of the PPO histogram and 14-day RSI, and each of those accounts for 5%. Chart examples. This first example shows a stock with a very high scooter above 90. This is Texas Instruments, and when you look at the indicators, you can understand why. Texas Instruments is 18.5% above the 200-day EMA and 8.7% above the 50-day EMA. And then I've grouped the indicators down below, 6 of them. So you can see the long-term indicators, 125-day rate of change, very positive. I'm using the PPO to measure the percentage above the 200-day EMA. Medium-term, 20-day rate of change, very positive. And the percentage above the 50-day EMA, very positive. So those are contributing to a strong scooter. Then when we look at the short-term indicators, RSI is at the top end of its range. The PPO histogram is sloping down, but it only counts 5%. And you put it all together, and you have a scooter that is near the top of its range, above 90. Next up, we have Disney, and Disney has a scooter that is below 20. And you can see it's around 3.7% below the 200-day EMA. It's a little bit below the 50-day EMA there. And then when we group the indicators, you can see the 125-day rate of change is negative. Again, the 20-day rate of change is just barely positive, but that's a medium-term indicator. The percentage above the 50-day EMA is barely negative there. Turning to the short-term indicators, you can see RSI is in the middle of its range. The PPO histogram is sloping up, but it only accounts for 5% of the indicator score. And you can see you put it all together and the scooter is very weak, below 20. Ranking and grouping. So we add up all the indicator values with their weightings and we have an indicator score. And then we rank those indicator scores. And here I've got 10 stocks with their indicator scores, and they're ranked from the highest indicator score to the lowest indicator score. So AK Steel would be the weakest of this group. Fastenal would be the strongest. Using the S&P 500 as an example, we would rank the 500 stocks by the indicator score and then apply a ranking value, which would be the scooter. These ranking values can be grouped in buckets of 10%. So if you have the S&P 500, then you would have 10 deciles with 50 stocks in each decile. And so the bottom 50 stocks would go in the weakest decile, the weakest 10% of the S&P 500, and they would have a scooter score from 0 to 9.99. And then the strongest 50 stocks would go in the top decile, and they would have a scooter score from 90 to 99.99. So this way, you know your scooter score ranges from 0 to 100. The closer it is to 0, the weaker it is. The closer it is to 100, the stronger it is. And you can see these groupings, you know, somewhere between 40 and 60 is average. And then you get stronger when you get above 70, and you get weaker when you get below 30. Working with scooter tables. Now we've created a number of tables that make it easy and quick to find the strongest stocks or ETFs, or to find the weakest stocks or ETFs. And these can be found on the scooter tables pages. And if you go to the free charts page, which I'm on now, you scroll down to the summary pages, and there you can see a link for scooter reports. You can also access these scooter reports from your members page. Here I am on the members page. You have your control center on the left, and if you scroll down on that control center, then you will see reports and analysis tools, and there's a link for these scooter reports. Once you're on this page, you can navigate to mid caps, small caps, ETFs, Toronto, London, or Indian stocks. You can also change the period from intraday to end of day to 1 week. You can easily add and remove columns if you would like. You can change the number of entries, and you can search the table. And this is really handy if you're looking for a particular sector. So I'm searching here for technology. Anything that has the word technology in it will remain on the table. I've got some healthcare here, and that's because technology is in the name, but for the most part, I've got stocks in the technology sector. You can see here that I've entered the term internet, so I'm pretty much looking at only stocks that have internet for the industry group. And if I want to sort these, I can sort with the strongest at the top, or I can click that again to get the weakest at the top and the strongest at the bottom. You can also sort by volume or any of these columns by simply clicking the column heading. And that concludes this instructional video on scooters. Thanks very much for tuning in, and be sure to check out our other instructional videos.